Hi, everybody. Thanks for joining me. Before we get started, please take a minute to click subscribe to my channel to keep up with all of my latest investing and personal finance content. And please check out the link you see on your screen for a message from our sponsor, The Motley Fool. You can get the top 10 stocks you buy right now.
Tyler, dividend stocks can be great. All things being equal, an 8% yield is better than a 5% yield. Unfortunately, in investing, all things are not equal. Some stocks pay double-digit dividends right now and can be really tempting, especially for newer investors, especially when they're in the real estate sector, because newer investors tend to associate real estate with lower risk. In a lot of ways, that's true. When you're talking about equity REITs, meaning companies that actually own properties, as a group, they've had lower volatility historically than the S&P 500. But the companies that are paying these 10, 11, 12% or more dividends right now are not equity REITs. They're another group called mortgage REITs. And I've tried to do my part in talking a lot of my newer investor friends out of them. It hasn't always been successful. But maybe they'd like to hear this from someone they don't know. So Tyler, what red flags should investors notice when looking at some of these mortgage REITs?
Well, man, if you're the preacher for this, I'm definitely over in the choir, just clapping my hands and definitely cheering this on, because mortgage REITs, as I can understand the investment thesis. I can look at it and go, okay, if I can get a 13 or 14% dividend yield, I don't care what the shares do. Shares can go down a little bit, and I'm still sitting on a 12% annualized gain, right? The logic there sounds like it makes sense. The trouble is that with these companies for the past 13 years, I believe, perhaps even longer, dividends have been declining systematically. It's not, just here and there, oh, something went really bad and we cut their dividends. It happens routinely for a new myriad of reasons, taking on long dated mortgages while paying with short-term debts and just basically covering interest and, using the spread as your net profits. You start doing that long enough, if you run into problems where either you have to turn your portfolio over with costs, or you get run into a situation like right now where you have a bunch of long dated maturity mortgages up against really much higher short-term borrowing rates, and all of a sudden that spread is gone, it's wiped out. And that, this is the theoretical concept for it. And I'm not saying that's happened exactly right now, but that's the situation that these mortgage REITs are facing when they have to start turning over and refinancing some of that short-term debt while holding long-term mortgages that were maybe taken out 2019, 2020, 2021, when we had 3% mortgages and you have to borrow short-term at the 4 or 5% range. Your margin's gone. It's a loss.
But another thing, it might sound like the opposite is true when rates fall, but that's also bad for these mortgage REITs in a lot of ways, because it leads to prepayments. We saw a lot of that when rates declined really quickly at the beginning of COVID, for example. It went from the 4% range on a 30-year mortgage to below 3%. You saw a lot of prepayments happening, and that's a big risk as well. Mortgage REITs do well. The investment thesis holds up if mortgage rates stay steady. In reality, that doesn't generally happen. So if you look at the 30-year mortgage rate, like a chart of it over the past 10 years, there are very few periods where it stays very steady. And that's why as Tyler mentioned, you see the dividends decline over time. It's because they're constantly being faced with these bad situations where rates are fluctuating and it's hurting their underlying portfolio, either by eroding that spread that Tyler was mentioning or by causing massive prepayments, which a lot of, especially residential loans, are not protected from. Commercial mortgage REITs have a little bit of protection on the prepayment side. Residential generally doesn't. So it gets hit. These get hit anytime that mortgage rates move significantly. And I like to advise investors to generally stay away.
I always love bringing up this chart whenever we talk about mortgage REITs, because I think it's just the part and parcel of what we're talking about here. So since 2009, right, the dividends for Annaly Capital Management are down 70%. Dividends for AG&C are down 61%. And total returns over those times are nowhere near what the S&P 500 have done. And that's coming right out of the financial crisis. Probably like the best time ever to buy these mortgage REITs was at the depths of the recession in 2009. And even when you were to absolutely nail the valuation, you're still not doing great.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.